Dilution. Dilution is when you have to grow the company by either adding more staff and increasing your ESOP pool, or by giving founder equity away to other co-founders, or most commonly by raising capital from external investors and giving them shares of your company in exchange. Dilution is not a bad thing. It is just a common practice of trying to create more value in a shorter period of time by leveraging the capital you want to deploy to building your business. Of course, the best way to build your business is not to have to result to raising capital from investors. It's best to raise that capital from customers instead. There's no dilution in that case at all. In the case of a company that's just, say, has a bit of sales, has some market traction, and is trying to raise $1 million in capital to grow the company faster. Say the company before the raise considered the value of the company to be $4 million, and then with new capital coming in, $1 million in additional capital, the post-close valuation of the company would be $5 million. So in that case, the company, $1 million of new investor money coming in, would be effectively owning 20% of the company. The company would be getting diluted by 20% of their stock. So if I previously held a position, say as a founder of the company, with 30% of the company, my position post-close would be 24% of the company after the additional $1 million. Now, that may seem like it's a bad thing if you're thinking in terms of percentages, but in fact, if prior to the funding round, you'd always thought that the shares were worth, say, 50 cents each, and post the funding round, your shares are worth $2, you as an individual will be increasing the value of your shares even though you're getting diluted. That is dilution. Dilution.
VC Lingo. Lingo.